Hello and welcome back to All Things Money. I'm the host, David Blain. Thank you for joining us today. During this segment, we'll talk a little bit about current market action and what's going on in the markets. People starting to get a little panicky again, and I thought I would just kind of put it in perspective. Yesterday, which was Monday, the S&P 500 six-day losing streak, the longest decline of 2012, came to an end. The index closed the day up about 1.6%. And the index is up around 4% for 2012, which is still 7.26% below the interim high set in April. So basically what happened, the market went up almost 13% in the first 13 weeks of the year. Way too high, just not sustainable. And so we had a fairly decent correction right now, off about 7.26% from the beginning of the year. Now, going back to a longer-term perspective, the market high, all-time high, is still October of 2007, which was around 1565. We're currently just above 13,000. And I just wanted to put that in perspective. Once again, people getting a little panicky. This typically happens. If we look at the anatomy of the market, from October of 2007, the market started to decline. You had about a 20% decline up until, I think it was around March of 2008. The market went down about 20%. Then you had a little bit of a rally, maybe 10%. And then in 2008, starting in the summer on into the fall, and then 2009, things got extremely bad. Ultimately, the S&P 500 declined 56.8%. It took 17 months to reach that low. And I've said this many times on the show that people start panicking over one-time events. These one-time events, the Greek crisis, the election of the new French president, things like that. People just sort of panic, these one-time events. Even the Great Recession, it took 17 months to go down 57%. Ample time to sort of realize what's going on in the markets. Now, with the volatility that's out there today, the somewhere between 15 and 20% decline is, I say, somewhat normal. Since the market low in March of 2009, sort of went straight up for a while, and then in the summer of 2010, between about April and July, the market went down 16%. Once again, people started panicking a little bit. If you're a long-term investor, which hopefully most of you are, and if you have any sort of mitigation in your portfolio, either bonds or tips or gold or something that is moving counter-cyclical to stocks, you didn't experience that full 16%. But if you're a long-term investor in equities, you have got to be willing to accept, a 5 to 15% decline in your portfolio. Then again, last summer, and once again, these are declines. They take a couple of months to occur, but there's no real reason. It's mostly psychological. Then last summer, we had the debt downgrade of the U.S. and the whole debt crisis, and during that time, the market declined about 19%. Once again, people mostly panicking. It happened over several months, but the big panic was in September when the market lost around 10%. Then we've had a nice recovery since then up until the April 2nd high, and we're off about 7%. My point in going through all this, and it may be hard to sort of visualize on the radio, but I'd encourage you to take a look at some longer-term data. And we're not saying you should just buy and hold and put your head in the sand. We certainly don't agree with that. We think that there is opportunities to protect capital. But my point is that you have to be willing to assume some sort of decline in the portfolio, and that these one-day panic event or 1 month or 2 month panic events are not necessarily the sign of an impending disaster. Just kind of a little lesson for you. Once again, we don't think you should just stick your head in the sand and buy and hope. We do think that by adjusting the risk profile of the portfolio at certain times, that it is beneficial. However, what you're looking for is you've got to prevent the major declines. You know, the greater than 20% declines are the ones that really hurt. If you have any sort of buffer in your portfolio other than 100% equity, you're not going to experience that type of decline, but it is a fairly normal process. And being able to get out of the way of the major bear markets, the 2000 to 2002 bear market, the 2007 to 2009, those are the ones that you should build your investment philosophy around to try to avoid those. The 7% decline from April, you really should not worry about that type of decline unless you're some sort of short-term trader. Okay, let's talk, on a global basis, what's going on in the market is basically people, the psychology at work. As more market participants are involved in investing in financial assets from all around the world, you see this crowd psychology become more into play, and something happening in France or Greece or China affects us more and more every day here in the U.S. And it's this sort of mass psychology of people is becoming more and more important than the fundamentals of the company, of stocks or even bonds. I mean, who would imagine that the 10-year yield of U.S. Treasury bonds would be about 1.8%? I mean, that's just very low to lock your money up for 10 years. So we see that investor psychology is beginning to trump fundamentals in many respects, especially over the intermediate time frame. Well, when we come back from our break, we'll continue with the discussion talking about what's going on in the markets and the economies from around the globe. I'm your host, David Blain, and we'll be right back.